shout as soon as I need some help.
Okay.
Take care, Nicole. Chapter 1, Introduction to Corporate Finance. Okay, we've decided to stick with the course. That's a good thing. We're going to dive into what corporate finance is all about. Again, I mentioned in my intro module that these are kind of building blocks or just a step-by-step way of learning corporate finance. The first 3 chapters, admittedly, are not that exciting. We're going to be going over just how the different parts of a corporate finance matrix work. We're going to be talking about the income statement and the balance sheet, fundamental stuff like that. We'll begin to get into what is the source of cash and what's the use of cash as the balance sheet changes. And believe it or not, that's going to open the door to the time value of money. So everything is kind of linked to one another. And hopefully by the time the 8 weeks are over, it'll all make sense. Let's talk about the introduction to corporate finance. And I'm going to have to run over here for a moment. This is the wonders of modern technology. I have to actually go to the keyboard when I pause too long to get it jump started. Okay, key concepts and skills. Hopefully you can see this. The different skills we hope to employ in this course are as follows. In Chapter 1, we want to know the basic types of financial management decisions and the role of the financial manager. Now ask yourself, well, who's the financial manager? That could be the treasurer, that could be the chief financial officer, that could be the controller, could be the assistant treasurer, could be the assistant controller. There's a whole host of people that make up a finance department. All work in different specialties. The controller oftentimes is behind the scenes. He's the one that's doing the cost analysis. He's the one that's doing, he or she, is the one doing the taxes, stuff that may be used by the regulatory people. The treasurer, on the other hand, may well be doing investor relations. He or she may be doing the treasury management, although that is sometimes done by the controller. So they're interchangeable, but oftentimes the controller is behind the scenes, kind of in the back office, if you will, whereas the treasurer is the one that's in the public view. Both report to the chief financial officer, and the chief financial officer will be the person that oftentimes is quoted in the press. You know, she said this or he said that. That's oftentimes coming from the CFO. We want to know the financial implications of the various forms of business organizations. Let's talk about that in layman's terms. If you have a sole proprietorship, if you have a partnership, if you have a corporation or an S-Corp or an LLC, each one has different considerations when it comes to taxes, when it comes to being able to be sued. It varies from company to company, so we'll explore that. We want to know the goal of financial management. What are they trying to do? Do they want to maximize profits? Do they want to maximize sales? Do they want to have the highest possible productivity? Or is it none of those? By the way, the answer is none of the above. We'll get to that. We want to understand the conflicts of interest that can arise between owners and managers. The owner of the company has specific goals. The manager of the company has specific goals. They don't necessarily jive with one another. There's actually a disconnect, and we'll explore why there's a disconnect. And we want to understand the various types of financial markets. We will touch on that. You'll learn very quickly that I pick and choose what PowerPoint slides I think are important and which ones I don't think are that important. And you'll quickly see that I oftentimes skip over a lot of slides. I want you to be rifle scoped with what you're learning. I want you to learn the stuff that you can take with you outside of this classroom. And so my goal is that you actually use 5190 long after you take 5190. You'll notice the chapter outlines are very redundant, so we don't spend a lot of time with them. So what is corporate finance? Well, let's ask three questions. What long-term investments should the firm be using? How should the firm raise funds for those selected investments? And how should short-term assets be managed and financed? Yes, companies actually have to finance their short-term assets. When accounts receivable build up, when inventory grows to unnecessarily large levels, that's a cost to the firm, and they actually have to borrow money to actually finance that. We'll be exploring that in detail. So we've got a balance sheet, and all of you are familiar with the concept of a balance sheet. If you've taken the accounting course here at Lake Forest, then in essence, you're familiar with the fact that an income statement measures activity in a period of time, usually 3 months or 12 months. A balance sheet, on the other hand, is a snapshot. It's an instant in time. The balance sheet doesn't say for the year 2017. It says for December 31st, 2017. It's just one instant in time. These are the assets, these are the liabilities, this is the equity. You've got current assets, you've got fixed assets, both tangible and intangible. You've got current liabilities, long-term debt, and shareholders' equity. The beauty is the left side in aggregate equals the right side in aggregate. So there's a little bit of a balancing process there, thereby giving it the name, the balance sheet. You've got capital budgeting decisions for each one. For instance, with the fixed assets, what long-term investments should the firm employ? For the liabilities and the debt and the equity, how should the firm raise funds for selected investments? Should they use all equity to finance things? Should they be using all debt to finance things? What are the risks and what are the costs if they exclusively use one or the other? We'll get into that. How should short-term assets be managed? And how should they be financed? This is a very ingenious question because we've got something called net working capital. Net working capital is nothing more than current assets minus current liabilities. When we get into ratios, we'll have a ratio called the current ratio. And the current ratio is current assets divided by current liabilities. And believe it or not, we want it to be 1 or greater because we want the current assets to at least cover their short-term obligations, also known as current liabilities. So you can think of the overall value of the company as being a pie. Now, I got to be careful because I'm introducing the word value. We're not quite sure how we get a valuation just yet, but by week 8, you'll definitely know what a valuation of a company is. The goal of the manager is to increase the size of the pie. So now all of a sudden, we've got the manager who supposedly wants to maximize value. you'll find out in a few slides that maybe that's not always the case. The capital structure decision can be viewed as how best to slice up the pie. How much debt do you want to introduce? How much equity do you want to introduce? And if you slice the pie in a certain way, then all of a sudden the capital decision actually matters and makes some sense. Notice in this example we've got 50% debt and 50% equity. For a very cyclical or seasonal company that has good sales one year and really weak sales another year, 50% debt could lead the company to bankruptcy in a really lean year. So how you set up the capital structure could have dire implications. So let's talk about the financial manager. The financial manager's primary goal, make a note of this because this is really important. The financial manager's primary goal is to increase the value of the firm. Not to increase sales, not to increase net income, to increase the value of the firm. That is the overall goal of the financial manager. Mind you, that's also the goal of the owner of the firm. Now, at a public company, the owner of the firm is the shareholder or the shareholders. So the person that owns shares in the company wants to maximize the value. That means the stock price will be as high as it can possibly go. The manager is the president and the chairman of the board and the chief financial officer and the chief operating officer. They are the managers. The question that we have is, are their goals always aligned with the owners? More to come on that. So how do you maximize the value of the firm? Well, by one way, you select value-creating projects. We're going to learn how to compute net present value. We're going to learn how to compute the internal rate of return. We're going to have ways to identify value-creating projects. And that is going to increase the value of the firm for us. So the methods that we learn in this course can actually help you at some point down the road recommend ways to improve the value of the overall company. You also want to make smart financing decisions. How do we make smart financing decisions? Well, we don't want to put the company in peril, but we also don't want to finance the company with the most expensive means of financing. And you'll hear me go into much greater depth on this, but the highest cost way that you can finance a company is to use nothing but equity. If you use 100% equity, then you've wasted money because debt tends to be much more cost-effective than equity. Keep that in mind for future chapters. So let's look at a hypothetical organization chart. We do have a lot of boxes here. At the top of the house, we've got the board of directors. Underneath the board of directors, we've got the chairman of the board and the chief executive officer. We refer to the chief executive officer as the CEO. Directly underneath the CEO, we've got the president and chief operating officer, also known as the COO. And then beneath him, we have the vice president and the chief financial officer. Now, she carries an incredibly important position because she's the one that is going to determine how the money is allocated. How do we finance the company? And then once we've got cash in the company, what do we use that cash for? What do we invest in? Do we use it for property, plant, and equipment? Do we expand our operations overseas? Do we start a new line? Do we invest in something that we've never done before? These are some of the many questions the Chief Financial Officer has to answer. Underneath the Chief Financial Officer, we've got the Treasurer and the Controller. And this is basically a hypothetical chart. It's not the way every company operates. But in this example, the Treasurer has the cash manager, capital expenditures, the credit manager, and financial planning all reporting up to him or her. The Controller, on the other hand, in this example, has the tax manager, the financial accounting department, the cost accounting department, and the data processing department all reporting to him or her. If it happens to be a public company, one of the two, if not both, is going to be involved in Sarbanes-Oxley and being able to comply with various government regulations. They've got many, many hats they have to wear day in and day out. So let's get a really complicated chart just to confuse everyone. The firm and financial markets. The firm basically takes on issues of securities. The financial markets play a big role in what securities are accepted in the marketplace. The firm invests in assets. So once you've issued a bond or you've issued a stock, IPO, initial public offering, you've gotten money from the marketplace for those securities that you issued. You have to use that cash for something, so you invest in various assets. Typically, you'll start off by buying raw materials, so you can make something. The current assets go up. Maybe you also bought a building. Maybe you leased a building. Maybe you rented a building. That's a decision in and of itself. So you might have some fixed assets. You've also got some current assets. After that, you have some cash flow from the firm. Well, how do you get cash flow? What happens is you use the 50-ton roll of coiled steel to make an automobile. 27 hours on the assembly line, and suddenly you've got a finished product, a car. The car gets sold. You either get cash for it, or you may get some type of receivable, where every month you're getting a payment for the person that got the car. So you've got these accounts receivable coming in. After that, well, you just sold a car. Do you get to keep all of it? No, the government gets something called taxes. So you pay taxes to the government. You've also got dividends and debt payments. Well, the debt payments will go to the bank, or they'll go to the bondholders. The dividends will go to the equity holders that bought shares of stock in your company. Those all have to go out. And finally, whatever's left over is known as retained cash, and that becomes retained earnings on the right side of the balance sheet. That shows the value that's building over time in your company. The cash flows from the firm basically need to exceed the cash flows from the financial markets. And you want to have a net cash generating activity. So you want to be building cash over time. If you're not building cash over time, then the company, simply put, was a failed experiment. The corporate firm. Okay. The corporate form of business is the standard method for solving the problems encountered in raising large amounts of cash. Now, businesses can take other forms, but let me just point out, if you're in a corporation, the corporation can be sued, but generally speaking, the employees at the firm are insulated from being sued. That has changed in the last decade. Health South and a number of other companies Arthur Anderson comes to mind. You had the various foibles with about 3 or 4 other companies that showed some hiccups along the way. Each of those got sued because of mismanagement by the highest levels of the company. That's where Sarbanes-Oxley came in. Sarbanes-Oxley saw the mistakes that were made when certain companies were just totally mismanaged, and they now require the chief executive officer and usually the chief financial officer to sign off saying, we have taken a look at the numbers and we attest that these numbers are accurate. And there is some personal culpability if in fact they find there's fraud taking place at the company. By those 2 individuals signing off on the dotted line, there is the possibility they can be sued if things go south. So again, there can be things that are of no reason that the person in charge would have known they would have happened. But there are also times when there is blatant mismanagement taking place. It's the latter that Sarbanes-Oxley tries to protect the public against. So what are these other types of businesses besides corporations? Well, we've got sole proprietorships. That's where you've got a ma or pa company where one person runs the whole place, usually a very small business. You've got a partnership. Now, this could be a general partnership or a limited partnership. And again, some of that has to do with whether lawsuits can be directed against individuals or not. Then you've got corporations. Even within corporations, you've got a C Corp and an S Corp, and there are tax ramifications depending which one you choose. So let's compare this. Corporation, the shares can be easily exchanged. They're publicly traded, very liquid. You've got voting rights. Each share generally gets 1 vote. Not always the case. Tootsie Roll, there's 2 different classes of stock, and the people that started the company basically have the lion's share of the voting rights. Taxation. You've got double taxation. You know, it's funny. The corporation has earnings before taxes of $50, and they're in the 40% tax bracket. So they pay $20 for their share of taxes. And so they have $30 of net income. And then they decide to pay a dividend. So they pay $5 of dividends, and the net cash that goes to retained earnings is $25. Well, that $5 of dividends goes to one big shareholder. And at the end of the year, he or she has to report to the federal government, well, I made $5 of dividend income. And they're in the 40% tax bracket themselves, assuming there were an individual tax bracket of 40%. We're using this to make it a round number. So 40% goes for taxes, 40% of $5 is $2. $2 gets paid to the government for dividends. But we already paid the equivalent of $20 to the government earlier. So $20 went to the government from the corporation, and then another $2 goes to the government from the individual that got them. That's where double taxation comes from. So you're taxed twice, once as a corporation, and then a second time as the individual getting the dividends. We're one of the few countries that does double taxation. Reinvestment and dividend payout. A corporation has a lot of latitude as to how and when and how much it should be paying for dividends and how much to reinvest in the company. Corporations have very limited liability. As I said, individuals at the corporation largely are insulated. And continuity, we assume the corporation is going to last forever. So we don't say it's going to have a 5-year life or a 10-year life. We expect the company to be around for another 100 years. That's our assumption. How about a partnership? Well, a partnership is subject to substantial restrictions. So it's not totally liquid. If you wanted to sell ownership in it, it's going to be difficult. Voting rights. The general partner is in charge, and the limited partners may have some voting rights, but the limited partners may have very few rights, too. Taxation, the partners pay taxes on the distributions. For reinvestment, all the net cash flow is distributed to the partners. The liability, the general partners may have unlimited liability, but the limited partners, as the name implies, have very limited liability. And continuity for a partnership usually has a limited life. And this is quite distinct from a corporation, which is assumed to go on forever. Now, we have addressed the goal of financial management already, but now we're, kind of reinforcing what we said earlier. The goal of financial management is to maximize shareholder wealth, pure and simple. It's not to maximize profit or to minimize costs or to maximize market share. Those are all nice, but that's not the overall goal. Because if those three things are accomplished and you still have not maximized value, you fail. The person at the top of the financial management pyramid, first and foremost, wants to maximize shareholder wealth. That is his or her goal. So, we have a problem. There is an agency relationship. The principal hires an agent to represent his or her interests. The principal is the stockholder, the person that buys shares of stock in the company. Now, that person expects the company to maximize the value of the firm so that the share price goes up, and in essence, he or she makes more money than they originally invested because the wealth of the company keeps going up. They have managers run the company. Now, you might ask yourself, well, who are these managers that are representing the shareholders? Well, it's none other than the management of the company. So the chief financial officer and the treasurer and the controller and the chief executive officer are all managers that are working for the shareholder. And the shareholder basically expects them to have the same goals that he or she has, and that is to maximize the wealth and the value of the company. But you might have a conflict of interest between the principal, the shareholder, and the agent, the management of the company. Let's explore what that is. What is management's goal? Well, they might be a little bit different than the shareholders. Management might want nice bonuses and nice perks. They might want to survive. In other words, not have the company sold to someone else and they end up losing their job. And they also expect independence. They don't want anybody looking over their shoulder. Good luck on that one. Increased growth and size are not necessarily equivalent to increased wealth. You could find that the greatest way to build up the overall value of the company is to allow it to be acquired by someone else. Now, that would maximize the value of the stock, and the shareholder would be quite happy if that happened. But would management be happy? Probably not. Management would have to be looking for a new job. And so If the company gets sold to someone else, management is vulnerable. And therefore, even if that maximizes the value of the shares of stock, it may not be in the best interest of management. And so the agent, the management of the company, may have a conflict with the principals, the shareholders of the company. That's where the agency dilemma takes place. So how do we manage the managers? How do we manage the actual management of the company? Well, you can use incentives to align management and shareholder interests. Those incentives need to be structured very carefully so that you achieve your overall intended goal. The threat of a takeover could actually result in better management. And there's other stakeholders involved to boot. So bottom line, make sure that the company that you're investing in has something in place that aligns the goals of the shareholders with the goals of management. If that's the case, everyone's going to be moving in the same direction. Financial markets. We've got primary markets and we've got secondary markets. Primary markets, they issue the stock for the first time. You may have heard the term initial public offering. There's one time that the stock is going to be a primary market instrument. That's at the time that it has an IPO, an initial public offering. Any time after the initial public offering, when the stock is bought and sold, it's bought and sold in certain secondary markets. You may have heard of them, the New York Stock Exchange, the NASDAQ, exchanges like that. Everything that's being traded after the initial public offering is a secondary market transaction. So, the firm issues stocks and bonds to investors, money changes hands, comes back to the firm. As the stock continues to get sold among other people, you basically have the creation of a secondary market. And I'm not going to give you a quiz, so don't even worry about that last slide. These first three chapters, we're just trying to get our feet on the ground. If this were a face-to-face class, I would say any questions. One thing I will point out is there will be time where we set aside for you to call in and talk about anything that's on your mind. So we'll actually have some telephone sessions during the course of this class. Preview of coming attractions. That's it for the first module. I will now begin the second module.